optionchampion.com.
Today is Friday, July 15th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications. Nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade on this option expiration Friday. Monthly options are now off the board for the month of July, moving the August options up to the front month cycle. This week was loaded with economic data. On a 12-month basis, consumer prices rose 9.1% and producer prices rose 11.3%, both exceeding estimates. And weekly jobless claims came in at 244,000, up 9,000 from the previous week. Analysts were expecting jobless claims to remain flat from the previous week. Markets were lower on the week. The Dow finished down almost 50 points. The S&P 500 down 38. The NASDAQ Composite down 187. The Russell down a little more than 25.5. And volatility came in by 41 cents. Crude oil ended the week down $7.23. Gold down $34.40. Silver down 57 cents, and natural gas ended the week higher by $1.04. There were a couple of new trades this week. The first was TECK Resources, symbol TECK. At the time of my analysis on Monday evening, TECK was priced at $26.21 per share, 43% off of its one-year high, 30% below its 50-day moving average, and 22% below its 200-day moving average. Over the previous 50 trading days, the stock had an average net change of $1.23, average price range of $2.04, and a maximum price range of $3.70. Prior to that, the stock had a maximum price range of $4.86. TECK Resources is expected to report earnings soon, possibly near the end of this month. So knowing that there's an upcoming earnings release and the stock could move up to $5 in either direction, I decided to make a bearish play on the stock, or a downside play, a bet that the stock price will go down. On Tuesday the 12th, I bought a long put vertical spread in the August weekly expiration cycle with 45 days until expiration. I bought the 25 strike for $1.89 and sold the 23 strike at $1.18, resulting in a net debit of 71 cents. The $1.18 credit received from selling the 23 strike offsets the $1.89 paid to buy the 25 strike. The spread, or the difference, between the 25 strike and 23 strike is $2. So this is a $2 wide spread. The max profit and loss on this position is very easy to calculate. Because this is a long position where a premium was paid, as opposed to a short position where a premium is received, the max loss is simply the debit paid for the position. So in this case, my max loss is $71. It's a defined risk strategy. The max profit is calculated by subtracting the debit paid from the width of the strikes. This is a $2 wide spread, so subtracting the 71-cent debit from the $2 wide strikes, my max profit comes out to $129. Option contracts represent 100 shares of stock, so prices are multiplied by 100 for each contract traded. Since my risk is limited to $71, this is a low-risk trade. If TECK Resources comes out with strong earnings and the stock goes up sharply when I wanted it to go down, my loss will be very small. The second trade this week was Micron Technology, symbol MU. On Tuesday, Micron was priced at $59.18 per share, 40% off of its one-year high, 9% below its 50-day moving average, and 22% below its 200-day moving average. The stock's 50-day average net change was $1.72. Average price range, $3.02, and max price range, $6.26. The company had just reported earnings on June 30th, so I was safe with regards to any events potentially driving the stock price significantly higher or lower. But the $6.26 max price range over the previous 50 days is still a pretty big move, a little more than 10.5%. A decline of $6.26 would put the stock price at $52.92. I was looking to sell a put on Micron either by itself or as part of a spread, so that $52.92 meant potentially selling a put at the 52 strike or 53 strike. At the time of my analysis, the price of the 52 strike wasn't that great. The 53 strike had just an okay price, and as it turns out, the 54 strike had a more attractive price. So I decided to go with the 54 strike in the August weekly expiration cycle and sell the put by itself, not part of a spread. This is called a naked short put. The market was a $1.76 bid offered at $1.86, putting the mid price at $1.81. On Wednesday the 13th, with 44 days until expiration, I offered $1.80, but the new inflation data was released before the market opened, and the inflation report was a very bad one, and Micron was down almost $2 per share in pre-market. Seeing that the 54 put delta was at 26 cents and assuming the stock would be down over $1 at the market open, I raised my offer by 20 cents to $2. When the market opened, I was filled at $2.30, which was even better. A naked short put is a bullish position where I want the stock price to remain above the $54 strike of the put. If the stock price falls below the $54 strike price, I will be at risk of owning shares of the stock at $54 per share. So my max profit on this position is the $230 credit received on the sale. And my risk? Well, it's undefined because the stock price can fall anywhere between $54 and $0. A naked short put is a high-risk position, but my goal with a naked short put is to either close the position early and take profits or roll it out to a later expiration date if the stock price falls and tests the strike or falls below the strike and struggles to break above it. In this particular case, however, with Micron, I was able to take profits early. In just 2 days of opening the position, I was up $110. That's almost 48% of the total credit received. With 42 days until expiration, I could have held on to the position to see if I would profit even more, but 48% of the max profit in just 2 days is not a bad return. So I went ahead and closed it and took the $110 profit. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.